Hey guys, and welcome to your 2-Minute Money Manager. I'm your host, Stacey Johnson, and this answer is brought to you by MoneyTalksNews.com, serving up the best in personal finance news and advice since 1991. Today's question comes to us from Gary, and Gary says, Stacey, is it wise to purchase exchange-traded funds, ETFs? Well, before we answer Gary's question, I don't want to talk down to anybody, but I want to make sure we're all on the same page. So let's explore the difference between two similar investments, mutual funds and exchange-traded funds. Okay? Like I said, I don't want to talk down to anybody, but I want to make sure everybody understands exactly what we're talking about here. Now, you've probably heard of mutual funds because they've been around a really long time. A mutual fund is simply a way you pool your resources with other people, and you all own a small slice of a whole bunch of stocks or bonds or both, instead of just a bigger chunk of just one or two. This is one of the fundamentals of finance, guys. Safety through what? Diversification. Okay, so this is why you have mutual funds. They allow you to diversify. They also allow you to hire a company to help with the paperwork, as well as maybe some professionals who are theoretically smarter than you when it comes to knowing what to buy and when to sell it. And since these management fees are spread among so many investors, thousands, could be even millions, they're more affordable. So fund management can also be active or it can be passive. An active manager studies companies, then picks the stocks or bonds or whatever they think are going to perform the best. A passive manager is just picking stocks to mirror an index, like the S&P 500. Now, as you might imagine, picking stocks in an index is pretty easy relative to figuring out, what it is exactly you're supposed to buy or sell. And that's why actively managed funds typically charge a larger management fee than a passively managed index fund, right? According to research firm Morningstar, the average annual management fee for actively managed funds in 2018 was 0.67%, about 2/3%. Passive funds fees were a lot less. They averaged 0.15%. So neither one is 1%. They used to be a lot higher, by the way, but now their competition has brought them down. But anyway, you can see passively managed funds charge less for management fees than actively managed funds do. Now, one other thing to know about mutual funds before we move on, mutual funds may also have a built-in commission, which is known as a load when you buy or maybe when you sell. If they feature a commission, they're called load funds. If they don't, they're called no-load funds. And what we always want to buy, obviously, is no-load funds because we hate paying commissions. Okay, so let's summarize. Mutual fund allows you to spread your eggs among many baskets and hire professionals to watch those baskets. They make a lot of sense, which is why they've been around a really long time. In fact, they've been around since 1924. However, mutual funds do have drawbacks. One of them is that a mutual fund is valued only once a day. After the market closes, the fund manager adds up the closing values of all the securities in the fund, divides it by the number of shares of the fund, and there you have it, your price per share for that day. Now, you put in an order during the day today, while the market's up, you put in your order, and that's what you're going to pay, that price at the end of the day. If you sell today, that's what you're going to get, that price at the end of the day. Now, this is a simple system. It had to be in the days before computers, but there's a potential fly in the ointment there, isn't there? Namely, what if you want to buy or sell in the middle of the day? What if the market's tanking and you want to get out before it falls farther? What if it's rising and you want to get in before it goes up more? Well, when you trade individual stocks, you can do that, right? You can buy or sell in an instant, anytime the market's open. And if you choose, you can even name the price at which you're willing to pay or which you're willing to take if you're selling. But with a mutual fund, you place your order while the market's open, but you don't know the price you're going to get until after the market's closed, until after all those securities are priced. And so there's one of your big problems with mutual funds. And that leads us to ETFs. Okay, so remember what I told you. In 1924, there was no way to maintain split-second values throughout the trading day for the hundreds of stocks in some mutual funds portfolio. But by 1993, computers made those calculations simple, and the exchange-traded fund, or ETF, was born. So as the name implies, exchange-traded funds, ETFs, are simply funds that trade on a stock exchange. Like a mutual fund, they're a diversified portfolio with professional management. Like a stock, you can buy as little as one share in a few seconds anytime the market's open. You can also, like with a stock, you can choose the price you're willing to pay if you're buying or willing to accept if you're selling. So, an ETF, imagine a stock getting married to a mutual fund, and their offspring would be an ETF. It's got a little bit of both. Trades like a stock, acts like a fund. Now, ETFs also tend to have lower expenses than traditional mutual funds. According to Morningstar, the average expense ratio for passively managed ETFs last year was around 0.57%. That's less than it was for your typical mutual fund. So they're significantly lower than mutual fund cousins. ETFs do have at least one drawback, though, relative to mutual funds. Remember I was telling you about load funds? They have commissions. Well, as with a stock, when you're using an ETF, you're going to pay a commission every time you buy or sell. Now, typically, though, I say typically because there are now ETFs that you can buy actually with no commissions. There are actually hundreds of them, even thousands that you can buy now with no commission at all. So they could theoretically have a commission like with a stock when you buy or sell a stock. But there are also lots of them out there. You don't even have that problem. So now, let's get to the bottom line here. Let's revisit Gary's question. Is it wise to purchase exchange-traded funds? Is that a good way to invest? The answer, you bet it is, Gary. ETFs are super. They're a low-cost way to buy, own, and sell diversified groups of stocks and or bonds. But traditional mutual funds can be okay too. Like I said, ETFs are a little cheaper. Sometimes the management fee is a little bit lower, but there's nothing wrong with that. Now, if you're going to trade, in other words, you're going to buy and sell 3 times a day, well, ETFs you've got to use because they're trade like stocks. You can get it out of the market, like you can with stocks. So they're obviously going to be a better choice than mutual funds if you're going to be an active trader. But if you're going to invest for the long term, which is the only kind of investing I endorse or do for myself, either one will work. The key is just to find funds that invest in the right type of securities, perform well, and have low cost. So my advice for beginning investors, let's get specific. I would start with an S&P 500 index fund or ETF from Vanguard. I don't get paid by Vanguard for saying this. I just happen to use them myself. They're the lowest cost fund family. So Vanguard's where I would suggest you go. Now, the Vanguard 500 index fund or the ETF has one of the lowest expense ratios in the business, 0.03%. versus the ETF, 0.03%. This is almost nothing versus 0.14% for the mutual fund, which is also super low. So I'd probably take the ETF simply because of that expense ratio being a little lower. But take a minute, go to Vanguard's website and compare these things. You can find a link there to Vanguard from moneytalksnews.com, or you can just go to vanguard.com and just do a search for ETFs and mutual funds. You'll find the stuff you're looking for. I hope that answered your question, Gary, and I hope all of you are going to see me right here next time.